Have you and your partners watched both We Crashed and The Dropout?
I can't speak for all of them. I've watched both of them.
You watched both of them.
Yeah.
What did you
more
think?
accurate?
I think that, well, I don't know about accurate because Super Pump was not accurate just because they made up a lot of scenes.
Yeah.
Like Drummond wasn't very active at all, but he's in a lot of the scenes. So a lot of them were made up. I think Leto did a better job of showing you who Adam
100%.
Newman is, and really got into the character.
He was incredible as
He was
Adam
so
Newman.
good as an actor. Yeah.
And accurate
Yeah.
to your having met.
Yeah, and equally on the other side, I think that Travis, and you know him well, is way more nuanced. He's one of the grittiest, hardest working founders I've ever worked with. He's super intelligent. He can be really charming.
Yeah.
And those dimensions weren't explored in the characters.
Right.
Which I think is unfortunate.
I remember you telling me, this was, I don't know, in the height of WeWork, you said, Chamath, this is the single greatest salesman I've ever met in my life.
You told me also the
About
first
Adam
time,
Newman, you
You
said
said the
that.
first time Adam Newman came in, you and your partners, he left the room and you guys looked at each other and you guys were like, we just have to invest in this guy because he can just.
I said
like, when he comes
we
in-
should
when you-
never invest in real estate and we have to do this deal.
Yeah.
What was it?
Let's ask Brad a question.
Oh, wow.
Well, I watched the first, Jade and I were watching We Crashed. I watched the first 2 episodes, and the only thing I could think of, Bill, was what's Adam Newman's next company and where do I send the check? Because
I think he already, well, I don't know.
he's got something brewing.
I have a question for Brad. So I wanted to go back
morning.
to, I've been up here for like 8 hours today, Jake Al. I don't know how much more you want me to do. I'm exhausted after an hour of these things. I honestly don't know how you do it. You have a round of applause. He's been interviewing people for like 10 hours. I'm like done after an hour and a half. Anyway, Brad, so let's go back to the 100 times ARR multiples that people were paying last year. Because these investors, with the benefit of 2020 hindsight, they may look kind of sheepish, but we know these investors and the pace car setting the valuations for the whole industry, as these big giant hedge funds, we all know who I'm talking about. They're super sophisticated people. I mean, they've been very successful investors for a long period of time. What's the word used when we talked about it privately was gaslighted, that, the market was sort of gaslighting all of us into thinking that the public comps for these companies were much higher than they were. Is that why, is that behind the psychology of why these very sophisticated investors made these big mistakes, or how do you explain it?
Yeah, well, I think there's a massive amount of research that's been done that Buffett and Marx and many others have quoted, that your ability to calculate risk goes down when you see a bunch of other people doing that thing, right? Because your body, your mind's telling you, well, I won't die because I'm just doing what those other 100 people are. That's why there's herd mentality. That's why the lemming effect.
Confirmation bias.
Confirmation bias. And so it's not that, you didn't name them, but Tiger, right? We know them, they're great investors, et cetera. But you had to understand they were playing a different game, right? And so when people who were building portfolios of 20 names were trying to play the same game as a firm building a portfolio of 400 names, right? It was like trying to follow, SoftBank in 2017. So listen, we all thought SoftBank was going to be a wipeout in Vision 1. It wasn't, right? Now, I know he just had a huge recent mark. We'll see where it ultimately settles out. So, I think from my perspective, like Bill said, you get forced onto the field. There's a certain amount you have to do to stay in the game, to have the conversation. But listen, as far back as, last April, we were sitting around the table on Thursday at your place saying, this can't continue, right? And then in the fall, it was Bezos is selling, Musk is selling, like all the signals were going off, right? And so I think you have to know the game that you're playing. If you're a seed investor, an early stage investor, it doesn't matter what everybody else is doing. You have an obligation to play a differentiated game. And what I would say today is, if somebody calls me up tomorrow and says, hey, Tiger's doing this deal at 75 times ARR, do you want to do it? They would have to pry the dollar out of my fucking hand with a crowbar. I'm not risking my money or my partner's money doing something that we're not underwriting, no, I'm willing to underwrite, David, to that 5-year average. I think what you have in the market now is a huge opportunity because people are in a fetal position under their desk, scared that the world is forever changed because the CEOs of big banks go on CNBC and start hyperventilating about deglobalization and hyperinflation and all this stuff. And not one of them has actually built a model and deconstructed the components of CPI. I think the much more likely explanation is that the trends that existed for 20 years still exist. They were interrupted temporarily by us saving ourselves from a catastrophe with COVID. The transient thing that everybody has come to make fun of, right? Transient can be a year, 2 years, 3 years. We will look back at this graph and that inflation will roll over, and I suspect that those trends will continue. So I'm willing to underwrite to that. But if you told me you thought inflation was going to be 5% for the next decade and the 10-year was going to 7%, I would say short every tech company in the market.
No. Short everything.
Short everything in the market and don't invest $1 in venture until you have line of sight and the market has repriced it. That's what the market is wrestling with right now. We have some people who are saying, markets abhor uncertainty. And you have peak uncertainty. We have a war. We have, this is the hardest forecasting job of my career. I'll shut up. You have filibustering. But, that is, I think that is ultimately the question.
Yeah.
If you're a founder or you're an investor, what are you willing to underwrite to?
Yeah. And Bill, what are your thoughts in terms of early stage and
yeah,
Series
that's
A?
exactly what I was thinking. Like,
Me too.
He said, don't take it. Like if we love to invest in two people in a PowerPoint. Like if that investment can happen today and it doesn't matter. It doesn't matter if the inflation pops or interest rates go up. It won't affect them.
It doesn't even matter if there's a war.
It might help actually.
Yes, because you're hiring people at half price.
Right, and there's less competition. I mean, my biggest problem of the past 6 years was hyper competition. Like
finding a CFO.
No, not just talent. I'm talking about I'm talking about Uber and Lyft and like hundreds of billions of dollars of money raised in the private market and shot onto the playing field out of a cannon. That's brutal. And that's not happening if inflation's going up.
It doesn't allow the market to really sort out the winners and losers properly because the companies that should contract get propped up for a little bit longer. There's some talented people in those companies that don't then end up in the right home. I said this last week, the most transformational moment in our company's history, at Facebook's history, was during the GFC because of the fact that there weren't any other alternatives to go and work.
By the way, I found, and I shared this with my partners the other day, I found through my career, which wasn't 4 decades, but okay,
over 3.
that the window after the correction is the calmest, where there's least anxiety for me at least. Like everything slows down. People talk rationally. People aren't doing silly things.
It's nice, like a walk on the beach.
There's a lot more. There's a lot more communication that seems rational and pragmatic.
Well, and you can also maybe get to know a founder, understand the business over 3, 4, 5 weeks, and make a decision, as opposed to 3, 4, 5 hours, and they tell you, "Hey, term sheets."
Well, and people think more think about unit economics in a more reasonable way, and you're not.
I mean, this is why. I mean, the two of you invested in Uber. I know, because we've had this conversation. Bill's
he mentions it pretty frequently.
You're too humble to take credit.
I did get in for $25 million valuation.
But Bill's talked about, Benchmark's legendary for investing in eBay, and it was winner take all. Winner take all.
Yeah.
And I suspect that when you invested in Uber, you saw similar network effects. You said, "Oh my God,
100%.
an even bigger
His napkin
market.
drawing.
This is going to be winner take all." Unfortunately, what you didn't plan on was Massa raiding Saudi Arabia, getting $100 billion of free money, and then blowing it out of a cannon into the market so Lyft and everybody else could do diseconomic things. And literally for
I did not foresee that.
for 7 years,
The confetti cannon was not predicted.
so the entire profit margin of Uber was competed away by stupidity. And you tweeted last week, and I noticed it because Jason and I may have a little something on the line here, with respect to Uber. For the first time you tweeted after their quarterly earnings, maybe we're starting to see network effects show up at Uber. Because if you listen to the Lyft call, it was a train
For
wreck.
a decade, what that money did was it made those businesses what we call the consumer surplus.
Yes.
Meaning, what is a consumer surplus business? It's when all you win. Nobody else wins. The employees don't win, the shareholders don't win, the investors don't win, consumers win. You're getting subsidized rides, you're getting subsidized food delivery, you're getting some subsidized form of content, and there are these consumer surplus businesses that abound right now, that still exist, which are propped up by dollars that they're not being allocated because they're competitive. That's just because they had to be.
Negative unit economics to drive growth.
I mean, Lyft said on their call that they were going to continue subsidizing. In fact, they were going to increase their coupons.
I have a
It's
question
like
for you
increasing
guys.
the speed while the plane
Yes.
is about to hit
Yes.
the mountain.
Yes.
Sorry, Bill, I just want to ask you, the negative unit economics to drive growth trend was a big one for the last 8 years, and it certainly seemed to have played out at Uber, but a lot of other delivery companies. Do you think that as a strategy, assuming capital availability, negative unit economics to drive growth, and then once you have the network and once you've grabbed the market, you make money, is a reasonable strategy?
It all depends on whether you can rein it back in or not. And I think DoorDash did an incredible job. I think Jeff Bezos did an incredible job back in 2001. I think if 50 entrepreneurs try that trick, 49 are going to auger in.
By the way, but can I say the nuance part?
By the way, that's the best. I think that's such a key takeaway.
Well, there's
Such an important part.
there's another part about it. You can only pull it off as well as if in that moment you have an effective monopoly, which Bezos effectively did, and Tony did in those markets where he was operating. Nobody else was competing in Palo Alto, California, and
Well, they weren't competing the way he was. They weren't,
yeah.
for sure.
I have a question for the two of you guys. What do you guys think about something like Instacart in a moment like this? So $40-odd billion valuation, maybe gets reset to 24. Who knows?
They filed to go public?
They filed to go public confidentially.
Are you guys investors?
I'm not.
I'm not, no.
So candidly, what's going on here?
I mean, I think it's a provocative question because you have a business that's raised a ton of capital that was born of the era that we're talking about, that probably did things that were
Unnatural.
If they weren't negative unit economics, they were close. And they talked about it because they would say publicly, we're going to roll in advertising, and then that's going to bring us.
I got in trouble once. I was this is on Bloomberg, so I think you can find this clip. But I was talking to Emily Chang, and she said something to the effect of, did you just see this latest Sequoia round? And I said, and I made this joke. It was a complete joke. It's not true. I was like, yeah. I went to Instacart. I bought one mango, had it delivered for free. Then I bought a second mango. I sent an email to Doug Leone. Thanks for the second mango.
What a douche.
I bought 4 grapes, and I said,
I would,
consumer surplus.
I would
mean,
say
you can get 4 grapes whenever you want.
It's hard to judge a company from the outside because you can't look at the financials. But the product experience has evolved over a very long period of time. It's actually pretty good, and I suspect there's an asset value there. And whether that can match up with what someone can afford to pay it.
All right, we got
But I think
we got to wrap.